They told you the economy was strong, and you believed them. Because why wouldn't you? The headlines said growth was stable, unemployment was low, markets were holding, everything looked controlled. So you kept working, kept spending, kept trusting the numbers. But here is what they never told you. The numbers were never designed to show you the truth. They were designed to show you stability. Those are not the same thing. Stability and strength look identical on a headline. They feel identical when you read them. But one of them can survive pressure, and the other one can only survive if the pressure never comes. Right now, underneath every official growth report, underneath every unemployment figure, underneath every market index, there is a structure that has never been shown to you. Not because it is complicated, because it is inconvenient. And once you see it, you are going to realize something that will make you angry, not at the economy, at how long you were told to look somewhere else. Because the US economy is not fragile because something went wrong. It is fragile because of decisions that were made deliberately by people who understood exactly what they were building and built it anyway. This video is going to show you the structure underneath the numbers. All of it. And by the end, you will not need an official report to tell you what is happening. You will be able to see it yourself. But first, you need to understand the one thing the official story got completely backwards. Because the biggest lie in the US economy right now is not a number, it is a word. And that word is resilience. They called it resilience. The economy survived the highest interest rates in 40 years. And they pointed at the growth numbers. They pointed at unemployment. They pointed at the markets. And they said, see, the system is strong. But here is the question they never asked out loud. What exactly survived? Because this is what should have happened. Rates go up. Borrowing becomes expensive. Spending contracts. Businesses pull back. Households tighten. That is the textbook response. That is how a healthy system corrects itself. It absorbs the pressure. It resets. It comes back stronger. But that is not what happened. Consumers kept spending while taking on record debt. Corporations kept reporting profits while increasing leverage. The government kept GDP stable while the deficit expanded by trillions. The system kept moving, but it did not move because it was strong. It moved because every weak point was quietly covered. And here is the second twist, the one that should make you angry. You already knew something was wrong. You felt it. Prices that never came back down. Bills that kept climbing. Savings that kept shrinking. You were living inside the pressure the official numbers said did not exist. And every time you felt it, you were told the data said otherwise. That is not a communication failure. That is a gap between what the system measures and what the system is designed to measure. Because the official numbers were never tracking your reality. They were tracking the surface. And the surface was being actively maintained by three systems most people have never been shown. 3 layers, all running simultaneously, all hiding the same thing. What they are hiding is not an accident, and the first layer is already inside your wallet. The US economy stopped growing organically. Nobody announced it. No headline declared it. No official report named it. It just happened, quietly, over years. And 3 systems moved in to replace what real growth used to do. Layer 1, debt. When your income stopped growing fast enough to cover your life. The system did not fix the income problem. It gave you a credit card. Consumer debt in the United States is now at record highs. Delinquencies are climbing. Defaults are rising. But GDP still looks stable. Because GDP does not measure whether your spending is sustainable. It only measures that you spent. You were not resilient. You were leveraged. And the system called it growth. Layer 2, government intervention. Every time the debt pressure built too high, Washington stepped in. Stimulus, spending programs, fiscal injections directly into the economy. The collapse was prevented, but the debt did not disappear. It moved from your balance sheet to the national balance sheet. Trillions of dollars of private pressure transferred to public debt, and the official report said the economy stabilized. Layer 3, market confidence. Stock prices stayed elevated. Asset values held. Business investment continued, not because the fundamentals were strong, because investors believed one thing: that the support would never stop, that the Fed would cut, that Congress would spend, that the system would always intervene. 3 layers, all 3 running at the same time, all 3 built on the same foundation: the belief that pressure can be delayed forever. But delayed pressure does not disappear. It accumulates. And right now, all 3 costs are compounding simultaneously. What that chain actually looks like when it moves is mechanical, and it is far simpler than you have been led to believe. Here is the part that should scare you. Not because it is complex, because it is not. The chain holding this economy together is simple, and simple chains break in simple ways. Step 1. Your income stops keeping pace with your cost of living. Not dramatically, no headline, no announcement, just quietly, month after month. The gap widens. So you borrow, credit expands, spending continues. GDP looks stable. The official report says consumer confidence is holding, but you are not confident. You are stretched. Step 2. As household debt pressure builds, government spending steps in, programs expand, deficits grow. The injection keeps demand alive. Collapse is delayed, but the debt does not vanish. It transfers from your balance sheet to the national one, and the national debt keeps climbing. Step 3. As the national deficit grows, bond markets feel the pressure, so the financial system steps in. Investors price in rate cuts. Markets stay elevated on the expectation of future intervention. Confidence holds. Asset prices hold. The system keeps moving. 3 steps, each one propping up the layer above it, each one buying time. But here is the mechanical reality that changes everything. This chain only moves in one direction. Forward pressure, absorbed. Reverse pressure, a shock, a confidence break, a policy failure, travels back through every layer simultaneously. Not gradually, not with warning, all at once. And the deeper the extension, the faster the reversal. You now understand the mechanics. But mechanics do not explain why intelligent people built a system this fragile. That answer requires understanding something darker. Who benefits from keeping you inside it? Here is the most uncomfortable sentence in this video. The fragility was not a mistake. Every major player in this system looked at the structure, understood what it was building toward, and chose to keep building. Because in the short term, the fragility benefits everyone who has power. Governments. No administration wants a recession on their record, so policy keeps stepping in. Deficits keep expanding. The correction keeps getting pushed forward, past the next election, past the next term, past the next report. Always forward, never now. Corporations. Valuations depend on stock prices. Stock prices depend on confidence. Confidence depends on the expectation of support. So buybacks inflate share prices. Leverage protects margins. Earnings are managed to maintain the narrative. The system looks profitable, but leverage is not profit. It is borrowed time with a price tag. Financial markets. Investors stopped pricing in economic reality. They started pricing in policy response. Rate cut expected, markets rise. Stimulus announced, markets rise. Crisis contained, markets rise. The market is no longer a measure of the economy. It is a measure of faith in intervention. And you? No household wants to face the reality of declining purchasing power. So credit expands. Spending continues. The pain gets deferred. Every layer, every player, all choosing short-term comfort, all building the same long-term pressure. Here is the second twist. This is not a conspiracy. It is something more dangerous than a conspiracy. It is a system where the incentives of every player, naturally and automatically, produce fragility. No coordination required. No villain needed. Just incentives, pointing everyone in the same direction. Away from correction. Away from reset. Away from reality. Until reality stops asking politely. What happens when it stops? Is the question this entire video has been building toward. Here is the final truth. The economy is not being measured wrong by accident. It is being measured by instruments designed before the support layers existed. GDP was built to measure output, not the debt required to produce it. Unemployment was built to measure who has work, not whether that work covers the cost of living. Markets were built to measure investor confidence, not whether that confidence reflects reality. Every official instrument, measuring the surface, none of them built to see the structure underneath. And here is the paradox that closes everything. The more the support layers succeed, the more invisible the fragility becomes. Every intervention that works makes the next report look better. Every delay that holds makes the official numbers look stronger. The system generates its own cover, automatically. And that is precisely what makes this the most dangerous kind of fragile. Not the kind that shows cracks, the kind that shows nothing, until it shows everything. Because systems built on continuous support do not weaken gradually. They hold, and hold, and hold, while the pressure builds underneath. Quietly, invisibly, until the support shifts, even slightly, and then they do not hold at all. Not gradually, all at once. So here is what you now carry that most people do not. You can read an official report and see what it is not measuring. You can watch a market rise and understand what the confidence is actually built on. You can hear the word resilience and know exactly what it is hiding. That is not pessimism. That is clarity. And clarity is the only thing that actually protects you. If this is your second video on this channel, you are already thinking differently than most people will ever be told to think. Subscribe, because what we are going to show you next is not just how fragile the system is, it is what happens when the first layer finally breaks.